What I'm looking at is this race that's going on now between the president trying to bring down prices and address the affordability issue.
In 2025, the S&P TSX Composite Index outperformed major United States benchmarks by a decisive margin in both nominal and currency-adjusted returns.
The last century was defined by concentration of capital, production, and power. The next one will be defined by diffusion of technology, of energy, and influence, by the rise of the global south and new roles for middle powers like Canada.
While fewer than 10 American technology firms generated more than 50% of total index gains, and United States federal interest payments exceeded $1 trillion on an annualized basis for the first time in modern history. A convergence of concentration risk, fiscal strain, and currency softness that signals more than a routine market cycle. It signals structural divergence. For decades, the United States stood as the undisputed center of global finance. Wall Street milestones were treated as evidence of supremacy, yet beneath headline numbers, market breadth narrowed, volatility spiked following trade war announcements, and the United States dollar weakened against key developed peers, including the Canadian dollar. This was not rhetorical competition. It was the beginning of a capital shift that could expose financial vulnerabilities inside the United States at a scale never publicly acknowledged, with potential losses measured in the hundreds of billions of United States dollars if concentration risk and debt expansion collide. What appears to be routine outperformance may in fact conceal structural pressure building beneath the surface. Listen carefully to the end, because today I will reveal the part of this story that has never been fully disclosed, and the financial consequences could be far more severe than most investors are prepared to confront. Behind the record-closing bells and headline index milestones, the structural data tells a far more disturbing story. In 2025, the total federal debt of the United States surpassed 34 trillion United States dollars, while annual net interest payments moved beyond 1 trillion United States dollars, according to projections from the Congressional Budget Office. Interest on the debt is now consuming a larger share of federal revenue than many core domestic programs. That is not symbolic. That is structural pressure compounding in real time. At the same time, market concentration reached extreme levels. The top 7 mega capitalization technology firms accounted for roughly 30% of total market capitalization within major United States equity indices. Fewer than 10 companies drove more than half of total annual gains. When such a narrow leadership base underpins a multi-trillion-dollar market rally, systemic fragility increases. A single earnings disappointment, regulatory action, or revenue slowdown in one dominant firm can erase hundreds of billions of United States dollars in valuation within days. Valuations have stretched accordingly. In segments tied to artificial intelligence and advanced computing infrastructure, price-to-earnings multiples expanded to levels that historically required sustained double-digit revenue growth for many consecutive years simply to justify current pricing. Markets can anticipate growth. They cannot permanently ignore mathematical limits. Meanwhile, the trade war environment intensified volatility. Tariff announcements and retaliatory threats triggered measurable market swings within hours of executive statements. Policy unpredictability has become embedded in pricing models. Investors now factor political risk premiums into discount rates. Even a modest increase in risk premiums can compress valuations across sectors, particularly those dependent on global supply chains. The currency dimension compounds the vulnerability. The United States dollar weakened during portions of the year against several developed peers, including the Canadian dollar. When a currency softens while equity valuations expand, real purchasing power gains diminish for international investors. That dynamic discourages foreign capital at the margin. Consumer balance sheets add another layer of strain. Credit card balances in the United States exceeded 1 trillion United States dollars. Auto loan delinquency rates rose compared to prior years. Student loan repayments resumed following pandemic-era pauses. tightening discretionary income. A stock market rally concentrated at the top does not eliminate household leverage risk at the base. Individually, none of these factors guarantees crisis. Combined, they form a pressure system beneath the surface of apparent strength. The rally may appear powerful, but its foundation is narrower, more leveraged, and more sensitive to policy shock than headline numbers suggest. And what few analysts are publicly discussing is how quickly these pressure points could converge under a single external trigger. That trigger may already be forming. In 2025, the most important movement in North American finance was not a headline index milestone. It was capital rotation. According to cross-border flow data compiled from global fund trackers and central bank disclosures, international portfolio allocations into Canadian equities rose meaningfully during the second half of the year, while net inflows into certain United States-focused funds slowed during periods of trade war escalation. Even a reweighting of 2 to 3 percentage points by major institutional investors can redirect tens of billions of United States dollars. In aggregate, these adjustments compound. The catalyst was not ideology. It was risk modeling. When tariff announcements from Washington triggered intraday market swings exceeding 2% within hours, volatility metrics spiked. The CBOE Volatility Index recorded multiple surges following trade war rhetoric tied to expanded duties on strategic imports. Markets do not respond well to unpredictability. When trade policy becomes a tactical lever rather than a structured framework, corporations adjust capital expenditure planning and global investors adjust exposure. Foreign direct investment patterns reinforce the divergence. Canada secured multi-year commitments in liquefied natural gas infrastructure, critical mineral extraction, and renewable transition supply chains. Projects tied to lithium, nickel, uranium, and cobalt moved forward under long-term contracts. These are not speculative inflows. These are decade-scale commitments anchored in geopolitical demand for secure resource access. Meanwhile, within the United States, corporate executives began flagging tariff uncertainty in earnings guidance. Manufacturing firms exposed to cross-border supply chains faced cost forecasting challenges. Agricultural exporters monitored retaliation risk. When margin visibility declines, hiring slows. When hiring slows, wage momentum weakens. The ripple effects extend beyond equity valuations into household stability. Currency markets amplified the shift. While the United States dollar remains the dominant global reserve currency, incremental diversification trends continued. Central banks worldwide have gradually reduced the percentage of reserves held exclusively in dollars over the past decade. Even marginal adjustments matter at scale. A fractional reduction in reserve concentration translates into tens of billions of dollars redistributed across alternative currencies and assets. The Canadian dollar strengthened modestly during the year, reinforcing investor perception that capital was flowing inward rather than outward. Currency appreciation alongside equity gains sends a powerful signal. Confidence is being expressed through demand, not leverage. Debt dynamics further complicated the outlook for the United States. With federal borrowing levels elevated and Treasury issuance rising to finance deficits, bond supply increased. Higher yields reflect both inflation expectations and borrowing scale. Rising yields increase government interest expenses, which in turn limit fiscal flexibility during downturns. Investors monitor these trajectories closely. The broader macro backdrop intensified resource security concerns. As geopolitical fragmentation deepened globally, energy independence and critical mineral access became strategic imperatives. Canada sits at the intersection of these needs. Its reserves of oil, natural gas, uranium, lithium, and rare earth elements position it as a stable supplier in a fragmented world. In contrast, the United States, while resource-rich, introduced policy volatility that complicated long-term certainty for global counterparties. The psychological shift may be the most consequential. For decades, the United States was treated as the automatic default allocation for North American exposure. In 2025, that assumption began to erode. Diversification toward Canada was no longer a marginal hedge. It became a strategic allocation decision in response to trade war volatility, fiscal expansion, and valuation concentration. Capital does not announce departure with dramatic headlines. It reallocates quietly, then compounds. If current trajectories persist, borrowing costs, currency demand, and corporate investment patterns could diverge further between Canada and the United States. The financial consequences would extend beyond a single calendar year, reshaping competitiveness, labor markets, and geopolitical leverage. And the most unsettling question remains unanswered. What happens if a concentrated United States market, elevated federal debt, persistent trade war escalation, and slowing consumer resilience collide simultaneously? The early indicators suggest that convergence risk is no longer theoretical. By late 2025, the divergence between Canada and the United States could no longer be dismissed as cyclical variance. The trade war environment had evolved from negotiation tactic to structural variable inside financial models. Markets were no longer reacting to isolated tariff announcements. They were incorporating persistent uncertainty into long-term valuation frameworks. The economic scale at stake is enormous. The United States and Canada conduct more than 900 billion United States dollars in annual bilateral trade. Integrated supply chains span automotive manufacturing, agriculture, aerospace, energy, and advanced materials. When tariff rhetoric escalates within such a deeply interconnected economic corridor, even marginal policy shifts carry amplified consequences. In the United States, sectors exposed to cross-border inputs began modeling cost volatility scenarios. Automotive manufacturers faced higher projected input prices tied to steel, aluminum, and component imports. Agricultural exporters monitored retaliatory tariff risk from trading partners. Technology hardware firms evaluated potential restrictions on semiconductor supply chains. The cost of uncertainty is not measured only in duties collected. It is measured in deferred investment, slower hiring, and compressed margins. Meanwhile, Canada positioned itself as a stable counterweight within the trade war climate. Energy exports expanded under multi-year agreements. Critical mineral partnerships deepened with European and Asian industrial buyers seeking reliable sourcing alternatives. Financial institutions maintained capital ratios that reinforced investor confidence. Stability, once viewed as conservative, became a competitive advantage. The fiscal contrast sharpened the divergence. United States federal debt exceeding 34 trillion United States dollars continues to grow alongside elevated interest obligations. Higher yields increase refinancing costs. As interest payments consume larger shares of federal revenue, discretionary fiscal maneuverability narrows. Markets monitor sustainability trajectories closely, particularly in an environment of rising global borrowing costs. Canada's debt to gross domestic product ratio, while not insignificant, remains comparatively lower, reinforcing perceptions of relative fiscal discipline. This difference influences sovereign risk assessment, credit outlook, stability, and institutional allocation mandates. Even small shifts in perceived sovereign stability can redirect long-term pension and insurance capital. Volatility patterns tell a similar story. United States equity markets experienced repeated swings following trade war announcements and executive commentary. Investors began assigning political risk premiums to sectors previously valued purely on earnings growth. In contrast, Canadian market fluctuations remained comparatively contained, reflecting policy continuity and regulatory predictability. Concentration risk remains perhaps the most immediate vulnerability within the United States. When a handful of mega capitalization firms dominate index weight, systemic exposure increases. If artificial intelligence revenue growth decelerates, or if regulatory scrutiny intensifies, valuation compression could cascade through retirement accounts, institutional portfolios, and passive investment vehicles. The wealth effect that has supported consumer confidence could reverse rapidly. Consumer balance sheets already show strain. credit card balances exceeding 1 trillion United States dollars, rising auto loan delinquencies, and resumed student loan obligations reduce household financial flexibility. A market correction layered onto elevated consumer leverage would magnify economic contraction risk. None of these elements alone guarantees crisis. Together, they form an interlocking system of sensitivity. Trade war escalation, federal debt expansion, valuation concentration, currency softness, and consumer leverage now coexist within the same macro environment. Canada's advantage in 2025 was not scale, it was composition. Distributed sector growth, currency resilience, resource security, and regulatory conservatism created a profile aligned with long-term global demand trends. Investors responded accordingly. Financial dominance is rarely lost in a dramatic collapse. It erodes through comparative underperformance, incremental capital reallocation, and subtle confidence shifts. The United States remains a formidable economic power. Yet for the first time in a generation, automatic supremacy is being quietly questioned within global allocation committees. If trade war volatility persists and fiscal pressures intensify while capital continues rotating north, the consequences will extend beyond equity rankings, borrowing costs could diverge. Investment pipelines could shift. Strategic partnerships could realign. And the final variable has not yet been tested. What happens if global growth slows while these structural pressures remain unresolved? Because if that scenario materializes, the financial repricing that began quietly in 2025 may accelerate with a force few are prepared to absorb. By the end of 2025, the divergence between Canada and the United States was no longer theoretical. It was visible in capital flows, currency performance, volatility spreads, and sector composition. But the most consequential phase of this shift may not be the outperformance itself. It may be what happens next if multiple pressure points converge simultaneously. Consider the structural alignment of risk inside the United States. Federal debt exceeding 34 trillion United States dollars continues to expand, while annual interest costs approach or exceed 1 trillion United States dollars. That trajectory reduces fiscal flexibility at precisely the moment geopolitical instability, trade war escalation, and industrial reshoring demand capital investment. If growth slows even modestly, revenue shortfalls could collide with fixed interest obligations. Markets price sustainability, not promises. Now layer in market concentration. When approximately 30% of total index capitalization is controlled by a narrow cluster of mega capitalization technology firms, systemic exposure intensifies. If artificial intelligence revenue expectations moderate, or regulatory frameworks tighten domestically or abroad, hundreds of billions of United States dollars in market capitalization could evaporate rapidly. Passive index funds, retirement portfolios, pension allocations all are tethered to this concentration dynamic. Add consumer leverage. Credit card balances exceeding 1 trillion United States dollars, elevated auto loan delinquency rates, and resumed student loan payments reduce disposable income resilience. If equity valuations correct, the wealth effect that has supported spending could reverse. Consumption accounts for roughly 70% of United States gross domestic product. A contraction in household spending would reverberate quickly through employment and corporate earnings. Finally, overlay persistent trade war volatility. Tariff uncertainty disrupts supply chains, complicates cost forecasting, and discourages long-term capital expenditure. When companies hesitate to invest, productivity growth slows. Productivity slowdowns weaken wage growth potential. Slower wage growth undermines consumer confidence. The cycle feeds on itself. Individually, each factor is manageable. Combined, they form a synchronized vulnerability. Canada's structural position stands in contrast. Resource security, diversified sector exposure, comparatively stronger banking regulation, and currency resilience provide buffers against concentrated shock. Energy exports tied to multi-year contracts provide revenue visibility. Critical mineral demand linked to electrification and defense supply chains supports long-term investment flows. Regulatory predictability lowers volatility premiums. If global growth moderates in the coming year while these structural contrasts persist, capital allocation decisions could accelerate. Borrowing costs for the United States could rise relative to peers. Corporate refinancing expenses could increase. Fiscal maneuverability could narrow further. In contrast, Canada could continue attracting strategic investment tied to energy and mineral security. This is not a forecast of collapse. It is a recognition of inflection risk. Financial leadership is not lost in a single crash. It erodes through incremental repricing until one external trigger forces rapid adjustment. The trigger could be a geopolitical escalation, a sharp earnings disappointment among dominant firms, a sovereign credit outlook revision, or a synchronized slowdown in consumer demand. What makes the current moment unprecedented is the simultaneous alignment of fiscal expansion, market concentration, trade war volatility, currency pressure, and elevated consumer leverage inside the United States, while Canada benefits from stability premiums, resource leverage, and diversified sector strength. The quiet reordering of financial power is already underway. The only remaining question is whether this divergence stabilizes or accelerates. Because if acceleration occurs, the consequences will not be measured in headlines alone. They will be measured in capital costs, employment shifts, investment migration, and long-term geopolitical leverage across North America. And the most revealing data point, the one that could confirm whether this is temporary divergence or structural transformation, is about to emerge in the next fiscal cycle. There is one variable that could determine whether 2025 is remembered as a temporary divergence or the beginning of a structural financial reordering between the United States and Canada. That variable is confidence, not consumer confidence measured in surveys, not political confidence expressed in speeches. Institutional confidence, the kind reflected in bond auctions, reserve allocation, cross-border mergers, and sovereign wealth positioning. The United States still commands the deepest capital markets in the world. It still benefits from the global reserve currency. It still leads in technological innovation. But reserve currency status does not immunize a nation from repricing. It slows it. When federal debt exceeds 34 trillion United States dollars and interest servicing approaches 1 trillion United States dollars annually, bond markets begin modeling long-term sustainability. When the trade war becomes a recurring policy lever rather than a temporary negotiation tool, multinational corporations begin modeling structural supply chain alternatives. When equity markets depend heavily on a small concentration of mega capitalization firms trading at elevated multiples, portfolio managers begin modeling downside asymmetry. If those three forces intensify simultaneously, fiscal strain, trade war escalation, and valuation compression, the repricing could accelerate far faster than incremental annual divergence suggests. Canada's advantage is not size. It is insulation. Insulation through resource leverage. Insulation through diversified sector composition. Insulation through comparatively conservative banking regulation. Insulation through policy continuity, signaling. Energy exports tied to liquefied natural gas infrastructure provide revenue visibility measured in decades. Critical mineral contracts aligned with electrification, defense manufacturing, and battery supply chains provide strategic demand support. Institutional investors value visibility. Visibility lowers risk premiums. In contrast, the United States must now balance domestic fiscal expansion, geopolitical negotiation, and market concentration simultaneously. That balancing act grows more complex if economic growth moderates or if inflation proves less cooperative than expected. The most sensitive indicator in the coming year will not be an equity index level. It will be Treasury auction demand and foreign participation ratios. If foreign appetite for United States sovereign debt begins to soften meaningfully, borrowing costs could rise further. Higher borrowing costs would pressure corporate refinancing. Corporate refinancing pressure would reduce investment. Reduced investment would slow productivity. At the same time, If Canadian sovereign borrowing remains comparatively stable, while capital inflows continue supporting currency strength, the divergence widens structurally. This is how financial leadership shifts, not through declaration, but through compounding differentials in capital cost, stability, and trust. The trade war era was initially framed as leverage for negotiating strength, but if prolonged volatility undermines investor confidence, the cost of that leverage could exceed its strategic gain. Markets ultimately reward predictability over confrontation when uncertainty persists. The United States is not collapsing. Canada is not replacing it overnight. But the automatic assumption of unquestioned financial primacy is being tested in real time. And here is the unresolved factor that few analysts are openly discussing. If a global slowdown intersects with elevated United States debt issuance, concentrated equity exposure, and persistent trade war unpredictability, the correction would not remain confined to technology valuations. It would reverberate through pensions, municipal finance, small business credit lines, and household retirement accounts. That is the systemic layer beneath the headline rally. Canada's ascent in 2025 may ultimately be remembered not simply as outperformance, but as early positioning ahead of a broader repricing cycle. Whether that repricing becomes gradual adjustment or abrupt correction depends on the next 12 months of fiscal policy, trade war dynamics, and earnings sustainability. And the first confirmation of that trajectory will emerge sooner than markets expect. Canada did not surpass the United States in size. It surpassed it in stability, sectoral breadth, and risk-adjusted performance. While the United States celebrated symbolic index milestones, Canada accumulated distributed gains across banking, energy, mining, and infrastructure sectors anchored in tangible output and long-term global demand. The trade war environment amplified the divergence. Policy unpredictability introduced volatility into United States markets. Federal debt exceeding 34 trillion United States dollars tightened fiscal flexibility. Market concentration left major indices dependent on a narrow group of mega capitalization firms. Meanwhile, the Canadian dollar strengthened, institutional capital rotated north, and strategic mineral and energy investments reinforced structural confidence. None of this signals immediate collapse for the United States. It signals erosion of automatic dominance. Financial power does not disappear overnight. It reallocates quietly through capital flows, borrowing costs, and confidence premiums. If fiscal pressure, valuation, concentration, consumer leverage, and trade war volatility persist simultaneously, the repricing risk becomes systemic rather than cyclical. Canada's rise in 2025 may ultimately represent more than annual outperformance. It may reflect a recalibration of how global capital evaluates North American stability. The central question now is unavoidable. Is this a bold strategic recalibration for the United States or a risky miscalculation that could accelerate capital migration and structural repricing? The answer will not be delivered in speeches. It will be revealed in bond auctions, earnings reports, currency markets, and capital flows over the next fiscal cycle. Subscribe for more fact-based global analysis. Thanks for watching.